Over the past 3 years that we have delivered our mid-year M&A report, by far the most anticipated, the most appreciated part of the report is our all-star buyer panel. And no question, this won't be any exception this year. Please welcome my two guests for this year's panel, JJ Schickel of Eve Partners, and also Tom Connolly, co-founder and managing director of Red Dog Equity. Gentlemen, thanks for being here.
Great to be here.
Thank you for having us.
Well, for those of our audience that are not yet familiar, JJ, just give a little context of your background in this space and Eve Partners.
Yeah, thanks, Spencer. I've been in the logistics space. I've done operations, investing, etc. for 30 years. Started Eve in 2002. We only invest in logistics companies. We found around 160 transactions over that time period, about $12 billion worth of transactions, all in the logistics space, kind of all over the place over that time period. And in the small world category, Tom and I worked together a million years ago. So it's a great reunion, and it's great to see Tom and think the world of him, and really appreciate you having me on, Spencer.
You know, we're going to have to connect more often, JJ. I feel like you add $1 billion to that transaction total every time we talk. So we're going to have to.
It's been a very busy year. We'll definitely hold some of that.
And Tom, turn it over to you. Obviously, long history in this space. That's why you're here. Give us a little bit of background on you as well.
Yeah, absolutely. Well, again, thanks for having me. And as JJ said, in 2003, he brought me into Eve Partners in the early days, and we worked together for the better part of about 9 years, doing exclusively deals in transportation logistics. And an output of that, of the Eve's work, one of our clients was Brad Jacobs, and we helped put together the deal when he bought Express One to form XPO, and he recruited me to run M&A for the first 5 years of XPO when we went from 200 million to 15 billion. And was the kind of the lead M&A person in-house. And I left there about 10 years ago after we had gone through the aggressive growth phase of XPO on the M&A side, and had to take about 3.5 years out of the industry as part of the deal when I left XPO. And at that time, we formed Red Dog Equity with my partner, Toby, in Atlanta, and spent some time in other industries. And Red Dog is now invested in the waste sector, car wash sector, and most recently in the engineering staffing sector, but got back into logistics investing, after that period of time, and have, made one investment in the sector to date. And over that time, collectively between all industries, somewhere in this similar size range as JJ, in the 10 billion plus of total deals done in the sector, over the 23 years I've been, investing and playing in logistics.
I love it. Well, guys, listen, for those of you in the audience, I appreciate these guys sharing their time with us. The purpose of our time is to equip you with some knowledge of what's happening in the M&A space, but also some best practices that they've developed along the way that have allowed them to be successful in the world of acquisitions as they are. So let's just kind of get things out of the box here, guys. First half 2026, how would you describe in one word the M&A market? JJ, we'll start with you.
Busy.
Tom?
Quality deals have been getting done.
Quality. I like it. Busy and quality. I mean, those are the two magic words if you're in the transaction world, because for context, those often don't come together. So you might get one or the other, but so let's unpack that. There's a lot going on right now, and so I want to kind of provide some context to the market, and from your vantage point, what are you seeing? I mean, there's a lot happening between the freight market. We've got aging owner demographics, AI revolution. We've got tariffs. There's all kinds of disruption in this space. As you look into the M&A market, what do you think is driving that busy activity, and why?
You want me to go first?
Yeah, that'd be great.
I think it's been an interesting 3 years for those of us who live in transportation logistics. It's probably not been the best 3 years, but I do believe the macros started to turn, and a lot of I would say a couple of fundamental drivers on the macros. Number one, There's a lot of capital. So in addition to logistics being a underinvested sector for the last 3 years, I think the M&A market broadly outside of logistics has also been quite slow, which has led to a tremendous amount of capital sitting on the sidelines, both in companies and in private equity firms. And so this is America. There's an urgency to put capital out, and over a period of time, most people are getting benchmarked to the S&P or to the 10-year Treasury, and so there becomes this pent-up pressure. I think on the macro side, I think it's mostly a supply side dynamic that we're seeing, not a demand side. So I don't think the shipments, if you look at the CAS data, the government data year over year, it's not really dramatically different on the demand side, the shipment side. But clearly there was a report that Raymond James put out in the last couple of days that talked about the amount of supply that's been taken out. And when I talk about supply, I'm just talking about like drivers.
Right.
And that has, there was another Raymond James report that came out today that said spot rates in brokerage in week 10, ex fuel, not including fuel, are up 45% year over year. So it's not a demand driver, right? It's not like there's tons more shipments like it was in COVID. So clearly there's a supply side dynamic that's helping as well. So lots of capital, people getting off the sidelines because the macros are better. And I would just say it's pretty darn busy.
Yeah. And that's a fairly recent development. I mean, that's not that it's so, Tom, what would you add to that? I mean, obviously we didn't even address, the Supreme Court ruling and some other things. So throw that into the pot and then kind of add on to what JJ said.
Well, to kind of add on to it, and it's a little bit different color on it is, and that's why I started out with quality, because we walked into January with everybody thinking, okay, interest rates are coming down, everybody's revved up for a really hot deal market. Then we decided to start a war in Iran, and fuel prices went up. It's driven inflation. It's kind of slowed up some of the level of deal activity people thought they would be having this part halfway through the year, while still plenty has been happening and getting done. And I know JJ specifically has been really busy. But in general, you talk around the industry and it's been not as much deal activity in the market. And then you look at the dynamics of businesses, and you're right. I mean, the Supreme Court ruling, everyone's trying to figure out, what that's going to impact. Especially on it, the biggest thing that's impacting our business is what's it going to do to insurance rates going forward. And you're hearing all kinds of horror stories about the potential impact that no one can categorize. We finally have gotten some numbers in the last 2 days. It's not going to be quite as, stark as maybe the initial jerk reaction was going to be. What is fuel prices doing to businesses up and down the curve, depending on how they're managing and hedging fuel? How's that impacting, financial short-term and long-term? And then the demand characteristic, I think JJ said it best, is the demand hasn't changed. Some of the supply is driving, truckload prices through the roof. And we've seen people starting to try to, focus in on what is that going to do, impact overall performance. What are shippers doing? That they're having huge impacts on the upside on costs. And it's a supply side. And, they have to, will that be, how long will that last? Or will people start doing what they always do, is they add more supply and start bringing in more, which is, kind of what led to the fuel, freight recession we've been through for the last few years, where out of COVID, everybody added a bunch of supply and then all of a sudden slowed down a bit.
Can't help ourselves.
Doing it again because the government intervention, to a certain degree, of what they've done on the driver's side and found ways to bring drivers out of the market is, created some, created part of that problem that, it will all balance out at some level, but it's a lot of considerations when you're making investments right now. A lot of balls moving up and down at the moment.
And still, uncertainty around demand, right? I mean, and so let me back up, because I want to unpack this quality comment. I think for a lot of our audience, when they think about quality, it may not be the same definition as an experienced investor in this space. So maybe both of you can comment. When you think about a quality investment, what are some of the bullet points or the boxes that you're trying to check to go to an investment committee and say, this is a quality opportunity here?
Tom, you want to keep rolling?
Yeah, sure. When I use the term quality, to me, when I look at the companies and most of the good deals that have been done this year were really well run companies, starting out with what I always look at first, great management teams that know their business backwards and forwards. And they're in end markets or services, where they've established themselves as a clear leader in their market. And when you hit periods in the market environment where things are a little bit more volatile, quality companies seem to continue to always sustain pretty darn well. And then you look at some of the end markets and the industries they've been focusing on. Obviously, there's been a lot of boom to people that focus on, the tech and AI trade and servicing those customers. It's been an area of where quality's been driving and tipping over some of these better assets that people have been getting deals done in so far in 2026. But it's just top to bottom, really well-run companies that can survive even in more volatile markets. Not survive is probably too stark a word, but not have as much volatility up and down in their earning streams. And I've just noticed, that the things that have gotten done at good multiples this year have been mainly, really best-in-class assets in their end market, whether it's freight forwarding or other areas of 3PL or even asset-based. There's been some good deals getting done, but they're usually some of the best-in-class players. It seems to be most of what I've seen getting done this year.
All right, JJ, what did he get wrong there?
I don't think we got anything wrong. I think the way I would add it or kind of package it to your comments, Spencer, about like how we think about it when we go to committee. The transportation market in general, we technically are required to invest in non-asset or light asset type businesses. So there's a segment of the market that's asset based, which we love asset based companies. It's just from our investment mandate. And there's about 40 sub-verticals inside of that. And so you've got from left to right the most defended versions of those business models where you've got a really defendable market position. And then you've got some of the least defended sectors as well. All of them are great in their own right? So I think like as we go through and try to grade out what's the offensive strategy, which would include typically how do we go generate the returns with a customer-led strategy. So we typically start out our investments with some type of customer interaction, whether it's like a net promoter score survey or something. And the customers typically tell us areas that they're having in their supply chains where they want us to grow or where they might be having challenges. That would then lead our M&A strategy. So that's the offensive side. So we want to be able to see a path to generating organic revenue no matter what the market's doing. And that's a really good way to do it, is taking an existing logo and moving them into a new service or a new geography. Defensively, just I think these businesses are all great and they tend to be very, very durable businesses in markets. But what things make them durable? Maybe it's a well-positioned cross-dock or a tag or the management team. And then the last piece for us is just more about structural around execution, which I would say is more like alignment, right? Like, so how do we align with the management team with what they want to do? I mean, there are really fantastic opportunities and great companies where we end up not having perfect alignment, and so that's always an important piece to the puzzle, because it's all about the people, right? So at the end of the day, for us, quality always comes down to the alignment with the teams that are out there executing the plans.
I love that. Now, I want to throw it back to you, Tom. I like the genesis of the name Red Dog and like where that came from. And obviously you're applying that as part of your screening process too, as you're evaluating potential partners. Can you unpack this, like why that's important, and then as you're evaluating operators that you're going to partner, like what does it mean to be a Red Dog?
Yeah, well, as if you've been bored and actually read our website, the name came from a book called Man and Fool by Tom Wolfe, it was about an entrepreneur that built a real estate empire in Atlanta, and it's a metaphor for a force of nature entrepreneur that always finds a way to win. And that's been a common denominator, that I've seen throughout my career. When, JJ and I worked with lots of entrepreneurs in the early days of Eve, and then obviously partnered with Brad Jacobs, who's obviously always finds a way to win. And we look at the common denominator of success. And my partner Toby and I came up with, just the concept that finding that lead group of management team to partner with that's going to persevere in good times and bad times, but always finds a way to win and live and breathe their business. And then they on Saturday night you can call them, they'll want to talk to you. On Sunday mornings they'll want to talk. You call them talking about the numbers and how the business is doing. It's off the top of their head. Not like, let me find a report and get back to you in 2 days. And it's just looking for people to have that passion to drive the business and have the management skill and the ability to lead teams to go build something, special. And that's, whether it's driving the sales organization, driving the operations organization, driving the carry procurement organization, and sees the business across all levers every day and understands what's going on in the business. But it's, the ultimate common denominator we look for is finding that person or management team that has this complete focus on the company and the business and how to grow and scale it. And then where we come in is help them, hopefully bring a balance sheet to take it further. Almost every deal we've done, we partnered with an entrepreneur that built something on their back. And it's that next phase of growth where they've established they're better than their partners that are bigger than them at something, but they just didn't have the ability to get there on their own personal balance sheet. And you partnered with us. We're allowed to help them unlock that. And it's kind of, we let the red dog off the leash, we say, and let them run and give them the tools on how to scale and grow. And that's kind of been the thing we look for, there's great people to partner with.
What I like about that, Tom, it's so simple because like when you just put that out there, it's like the potential partners evaluating themselves and they're like, am I a red dog? Like, not anymore. That ain't me right now. Like so I might have been at one point, but not right now, not for the next 5 years. But other people will look at that and they'll say, that's exactly who I am. That's exactly like, it's the perfect match. And so I just really, sometimes I think that description, as opposed to like a lot of extra words, like you kind of have that, let the dog off the chain. Yep. And that's exactly what some of these business owners want and need to help realize the full potential of their logistics company. And so, anyways, I think that's really interesting. And I appreciate the way that you guys put that together. JJ, I want to come back to you. I love the content your team puts together on these Fast Five. It, just kind of focusing on these interesting deals that are getting done across our industry. And as you both kind of talked about, yes, there's challenges, but in these pockets, there's some really great companies and some fabulous transactions getting done. And your team's doing a good job. So I'll ask both of you, like just over the last 6 months, and it doesn't have to be, strictly within that window, but maybe a transaction over the last 6 to 12 months that really got your attention. Why was, what did you like about it and what was significant about it?
So first of all, I would just echo, when I first heard the Red Dog name, I was like, you couldn't have had a better name. I've known Tom for over 20 years and he is an absolute bulldog, and having a bulldog as your partner, I think, is really important. And I think it's a really good description of Tom and Toby as a private equity partner. I loved it. I thought it was great. A Man in Full is a great book. So I think our newsletter, Tom, and Tom was there when we were doing the newsletter. The newsletter now has we have a newsletter which has over 20,000 subscribers to it. If you're not on the newsletter, please get it. It's a quick snapshot of kind of all the deals over the course of that week that we can find. The Fast Five is designed to add a little more texture to what we consider to be the deal of the week. And that texture is to try to speak to a little bit of more of the why. I think the why is the most lost component. Because we don't do a good job as industry people explaining the why, people just think it's ultimately a financial transaction. That,
right.
Hey, there should be a lot more to it than that. And so that's kind of the attempt there. I think for me, and Tom, I'll say too, and I think it's fine if we both say the same ones, but I think Worldwide and AIT were the two main ones. I know, both Tom and I know Tom Medine at Worldwide and Vaughn Moore at AIT. Both of them are excellent leaders. And I think the main thing for me is seeing the top end of the deal market moving higher to get broader and better institutional representation. I mean, this is a 10% domestic GDP market. We have less than 2% institutional capital in the space. So it's very underrepresented. And so if you start thinking kind of the upper ends of these transactions, you've got like really, really big transactions occurring now, which I think just helps from the $1 million transaction all the way up. It just helps investors see that path. And it's just a better and better ecosystem. When Tom and I started, I mean, there's like hardly any investment bank. You know, I mean, it's just like everything's grown. And Spencer, look at you guys have done. And it's there's a lot more people that you're competing with, but you're never lacking for business, right? Mm-hmm. So I just think like seeing the top end of these things push out is just really, really great for the overall industry.
No, it's great context. Tom, what about you?
Yeah, I'm going to follow on the same line, but in a slightly different view as to why is the worldwide Thoma Bravo deal is really intriguing to me. One, I agree with JJ on the size of that deal and the AIT deal are very exciting for the sector and the space and the valuations that those deals were done at. You know, but what's really intriguing to me is, you know, because I worked for Brad, and if you followed us at all, you know, technology is going to disrupt the sector or change the sector, but done by real operators, not just by pure tech plays. This is the first time you've seen, we watch Worldwide grow from bringing in new shippers and bringing that whole business together and the value they're providing, and then partnering with Thoma and Octane to build the new, ship station platform. It's the first really big intersection I've seen the tech and the operator side come together in a major way. And what that's going to mean to that business is going to be very fun to watch and see, how that, because I believe that the technology, everyone's been talking about it for so long, the digitization of the industry, what's going to happen, who's disrupting who. And there really hasn't been that much disruption. There's been a lot of enablement by technology to make people more efficient and allow, people to do more transactions per head type of a thing. But this situation, it's going to be one of the more interesting ones to watch, just because the big tech investor comes in with a true operator and brings them into the portfolio, which even you haven't seen Thoma Bravo almost ever do. And that just gives you a sense. So I think it's going to happen in the sector in the years to come as a much bigger intersection between the tech and the operators.
Well, I think that's a great segue, gentlemen, into each of your playbooks. I mean, with the explosiveness of AI and the endless possibilities that kind of come along with that. How is that affecting how you look at your own investment profiles and preferences as you move forward? I mean, how are you internally thinking about both platforms and bolt-ons as it relates to a changing market and how you think about creating synergies?
Tom, you want me to go first?
Sure.
Well, I would say, so Eve, we talked about, one of the things that I didn't mention in the beginning, Eve stands for equity value enhancement. The fundamental idea that we were started in 2002 with is using acquisitions to support a customer-led strategy. As I mentioned a little bit earlier, that could mean moving into a new geography or a new service. And that allows you to go and cross-sell an existing customer and create some organic revenue, even when the market's slow. So regardless of what the market's doing, being able to use the acquisitions to fuel organic growth, even when the company's, maybe your customer's overall spend is going down, but the company that we're partnered with, their overall spend is going up because we're getting more of the wallet share even when that's going down. Now, obviously, when that turns around, that turns into an incredibly exciting situation. But I think having the ability to manufacture through that has always kind of been what Eve stands for and what we've been primarily focused on. And, it's customers, vendors, and employees. If you take care of those three things with your overall capital deployment strategy, you're going to be in a good shape, be in a good place.
Tom, what say you?
Yeah, I mean, philosophically, we're very similar in that respect, and it's like our current investment in the sector has a lot of very large customer names, and critical part of our growth there has been cross selling and expanding the service lines, and then in parallel to that, we used to say at XPO that how do you do that with customer and being aware of who you are in their eyes. We are a cost center to them, and there are always other people wanting the business from them, and how do you provide exceptional service to those customers is why they will allow you to scale and grow with them, and that's investing in the people, investing in the systems, and giving them better visibility and data and insights that maybe your competitors aren't doing, and being able to outservice some of your competitors by knowing that every day there's somebody sitting in a room looking at your budget on the customer side, and saying, are we getting value out of this logistics provider? And every once in a while someone new gets hired and they come around and they try to test it and flex it, and if you really invest in the right things, and when you have those days where they come back and want to talk about it, it allows you hopefully to maintain those relationships, but also, and JJ said it well, cross-selling was a critical part of what we've done at our current investment, as well as, XPO. That was a key part of our focus is how we cross-sold this business across, the many service lines we had. And I kind of, completely align with what JJ's thinking and how he approaches the customer-led approach. I think it's always been the right way, in my opinion, to do things.
Let me come back to you, Tom. I want to, both of you guys have had tremendous success over the last 20 years, vastly different freight cycles and all things going on in the economy, just constantly evolving. What has allowed you to maintain an investing discipline over that period of time? And what advice could you give to other folks that are a little bit, behind you in terms of experience?
No, discipline to a fault, maybe. I don't know. It's very important to me. Always has been that especially when I moved to the investing side, that you're investing other people's money. And I always say invest it like you're going to invest your own. And it's very easy that, you have somebody else's, capital to invest, and you can go run out fast and, pay big numbers. And I always say it's very easy to buy companies. It's very hard to invest in companies. And there's different types of people in the market that, some just, they get the checkbook and they just go buy, and hopefully they can buy average down over time and win books and win big processes. And, the way I've always thought about it is if you buy right at the front and you create a relationship with that seller where, price isn't the only consideration of why they want to do the business with you. And we've tried to, as our focus to defend logistics since JJ and I got together, and how we differentiate ourselves early on is we figure out how these companies worked when we sat down and talked to owners. It was a different conversation than just say, what's your EBITDA? And so the discipline comes from just a fundamental belief of how to do business, but also how do you get people to take that and value that? And when you have the chance to sit down and explain to them, what we can do post deal, and maybe someone else is going to offer you a slightly bigger check, but what we can do together, and we're going to make a lot more together post deal, and have now that had that happen many times across my careers with some of the XPO sellers, with some of the deals we've done inside of Red Dog, and by the way, and JJ and Eve have had a very similar track record, then you get repeat business because people start to learn that there's more value than just a checkbook and you're investing. But being disciplined is very, very important. And I've always tried to maintain that because I take it very personally that it's other people's money we're investing.
Well, let me throw you a little curveball, JJ. We'll go the other end of it. Tell us about a time where you were maybe a little bit too disciplined and maybe a good one got away. Tell us about an investment that you wish you could have back.
Yeah, I think just to pick up on Tom's point and then kind of pivot to your question, I think this is really, there's nobody who's got like the perfect book. There's no book that says here's how, there's a lot of great books and typically they chronicle something that went really well. There's not a lot of great books chronicling the things that didn't go very well.
That's right.
And it's just hard. I think like it's always a people at the end of the day, we're not doing patents and machinery and things that are separate from people. We're investing in partnering with people, and alignment is fundamental because work's hard, and there's very little chance you're going to get all the way through it with it all going perfectly. So what I would say is we're really indexing hard to the teams and the alignment. Less so focused on the X and O's of the transaction, but we are range bound to the market-based multiples, and you do find yourself leaning further and further around, out into the, this multiple standards of deviation away from where you probably should be because you see really good alignment. And you feel like the business is great, but you got really good alignment with the team. I would always rather have better alignment than a better company. I know that sounds a little weird, but there's just little chance it's all going to go perfectly, and you need to be partners. And so look, I think I look back and you just kind of say there's a lot of businesses we've made. 25 years, you're going to make a lot of mistakes. We made and missed a lot of great opportunities. It was always about the people, and they commanded really big prices. We didn't get there on whatever the situation was, and we should have because they always ended up doing well. But that typically tends to be the situation. You think about not that we've had Elon's a bad example, but it's a good use case because a lot of people are saying, oh, the valuation's crazy, but you know that the executive's really good, and so you have this fight club around your multiple your disciplines, your discipline around financial discipline versus kind of like really core alignment around your investment thesis. So that's tough. I don't have a particular one. I've got like 100 of them.
It's funny. I'll hear people talk about they'll ask our firm how can they become a better acquirer, and oftentimes it's kind of like just what you just said. Well, you have to do. You can't be you can't read it out of a book. You have to get reps in doing it. Make offers, have them rejected, to have them go tell you to jump in a lake. Then you kind of know how to get in market. And so I think that's good wisdom right there.
I think just to piggyback on Tom and I used to always say that. I mean, the benefit of having a person that's been in the industry, and both Tom and I have been investors and operators, and the main thing we have to offer is that we've made a lot of mistakes that we won't repeat, right? Like it's hard, right? You're gonna get things wrong, right? And you got to just get out there and do it, and find people that help, find advisors like you who help keep you out of the ditch, because it's not hard. It's just littered with learning lessons, right? Yep. And you can't skip all those because there's not a book that tells you how to skip them all.
And I think a trait that's critical on the buy side is in that supports all of that is just actually listening to the fellas and what's important to them, and not just trying to believe it in your textbook that you wrote or the M&A for dummies. And it comes down to listening to people, what's important to them, what's important about their business and why they see their business, the way it is valuable, and then building real connections with folks to be able to dig into, I think that, JJ said, alignment, and not just, but I think that, the simple loss, in this world sometimes is just listening to people versus people want to come in and talk. And I used to always say I get to a meeting I want to be talked the least in the first couple meetings. I want the seller to let them tell me everything about their business and go on. And I think the more you do that, I think the better you can figure out what's important to them and how to, put something together structurally that works for both parties.
I thought you were going to say, let the seller run their mouth. That's what I thought you were going to say, Tom. So,
no, I did not say that.
I just was out there. Let me stick with you, Tom, because I think we're at an interesting time. Many of our industry peers, even going back to like 21, we've had these crazy freight market volatile periods, and it's just there's a lot of great companies that just haven't found the right off ramp to exit yet. And I think that we're kind of reaching a point where market conditions are stable enough. I mean, they're not perfect, and then a lot of fatigue and a lot of folks who have masterfully solved a lot of problems over the last 24, 36 months, but they need a capital partner to kind of take on the future at this point. But a lot of them have never had a serious conversation with an investor like you folks. And so I'm curious, like, tell us about a time, Tom, where on a first impression, a prospective seller just nailed it as far as their first conversation with you, talking about their business, connecting relationally. What happened that made you get very excited about investing in that company?
Yeah. I first sat down with who's now the CEO of our logistics company. He had built a business for 30 years on his own. And we were able to meet. He actually ended up hiring an advisor to sell him, but I was able to meet him at a conference beforehand, and someone introduced us, and we sat down for 2.5 hours, just impromptu at the conference, and he just started walking me through all the little things he'd done to build his business, and he had built several Fortune 100 customers that trusted him, and he walked me through all the little things he did to service them and differentiate from his competitors, and he was able to even get big, huge shippers to change their behaviors and how they bought freight services from him, because he came up with solutions that were different, and that, by the way, ended up being more reliable and saved them money. And when you just talk to this person for 2.5 hours, and I'm like, what would you do if you had something bigger? And then he just went on for another 30 minutes about all the possibilities of where he could take the business, and that's where I you find that going back to the Red Dog, and you meet this person that has all this vision of all these ideas of what they could go do, and they just but they need to be unlocked, and that's kind of where that was a situation that gave me the conviction. And then he ended up hiring an advisor, and we went through a process, because I said earlier about discipline, but discipline it's kind of an interesting word, because this one doesn't mean you just looking for value. If you do the work and you have conviction that you might even have to lean into a deal to win it, but because you're willing to, you've done the work and what the potential of that business could be. I mean, my partner Toby's worked for someone that used to say, don't tell me what the market multiple is. Tell me what we're going to do with the business after we own it. And if whatever the value is doesn't really matter. If we believe in conviction that over 5 years there's something unique. I mean, you use Elon a second ago as an extreme example, but you can lean into a deal if you have confidence that there's just an unbelievable market opportunity for that business to be invested in and grown. It might look like your entry multiple might be high, but by the time you're done, it looks like a fantastic deal. And so it's trying to find those such situations. So that was one for me where, after just uniquely sitting down with this person for a few hours, it just had my brain spinning of this opportunity in kind of the B2B last mile sector.
I love that. JJ, how did a potential seller win you over in a simple conversation?
I think this is, I think a lot of what Tom said applies to my answer. I think on the fringe, I would just say that being focused in an industry and only one industry only, you attend the conferences, you meet a lot of people, and you don't. I think the nice thing is you'll meet somebody, you'll see them every year, you'll talk to them here and there, maybe see them at a couple conferences, make sure that they know what you're up to and vice versa. And then there's just like a moment of serendipity where it's like, okay, I'm ready, right? And it's nice because it's tough to, you need to make sure you're ready, I think is the main thing, because at least for us, we're typically focused on being partners. So we like our platforms and our add-ons to have a lot of equity, and we put out a lot of equity incentives out to the broader management team. And so you've got to kind of be ready for that partnership. Many of these companies that we work with haven't had an institutional investor before. And so it's not something to quote unquote sell them into, right? You just got to be ready. And so there's been a lot of situation kind of like what Tom talked about, where, again, I come back to alignment, but it's like they're ready to make that change, and it just makes everything go better when there's just like solid alignment on the front end. And so I think that's the only thing I would add to Tom's answer.
Related to that, what we find ourselves doing a lot of the cases, maybe 2 or 3, 4 years upstream, is just trying to educate folks about the different channels of an exit. Because to your point, JJ, they might think they're ready, but they're not ready for your type of partnership. And they just don't know what's going to be required of them. So for folks that want some type of chips off the table, maybe a lifestyle change, where do people in our industry have the biggest blind spot about partnering with industry specialized investment groups like yourself? And Tom, I'll start with you.
Okay. Trying to think of the right answer. So biggest blind spots of industry specialized, like I said, I think JJ was saying it well at the end there, but it's, a partner with, someone like us or with Eve, we need a partner who's worked hard, is probably really willing to work as hard or harder for a period of time to execute the growth plan.
Yeah.
So sit down with them all at the beginning and talk about succession. And I know most of them don't want to work, like that forever. But if they're looking for the chips off the table in a better lifestyle, there are solutions for that. There are solutions to sell to a public company or strategic buyer that will get rid of the management team and over a short period of time and bring in their people internally. But we're people, if you try to sell through, to do a deal with someone like us, and you're not ready to really even work harder for a period of time as we kind of try to scale the business, if the seller just gets focused on just price and sees you as just another buyer, and they don't pay attention to that, probably wouldn't work anyways, because the human capital alignment wouldn't be there. But I think sometimes you see where people don't understand that you're going to have a true partners. They're going to be asking a lot of questions. You're going to have and they're going to actually help learn more about your business sometimes than you ever thought you knew before, because you probably don't cut and slice and dice the business that way. When we rolled out dashboards to our logistics company, and all the insights, they didn't realize some of the things that were happening in their business every day that were actually happening, because they didn't, they get things once a week. And over time, they've said it's more fun, but for a period of time, it was like, wow, this is a different workload. So I think just making sure people are aligned with what's going to happen, and when they partner with someone like us or with Eve, because there is going to be a period of time where the workload goes up, not down.
Yeah. JJ, what would you add?
Yeah, I think Tom hit the main one that I think people just need to embrace, which is moving from, and again, if you have an institutional investor already, there is no change, right? I mean, it's just more of the same, better of the same, worse of the same, something like that, right? It's like, if you don't have an institutional investor already, it's just the financial quote unquote rigor, because to really fully deploy all of the levers that are available to allow you to go be more competitive. I mean, I think when we're trying to partner with someone, we want to see that glimmer in their eye where they want to corner their market, or, like I see this path. I want to have all tools available to me to go do that. Because you're going to go from 200 people to 5,000. I need to be in multiple countries. Whatever the answer is, you're going to need a level of financial rigor to make sure you're getting the capital. You're going to go public. You're going to get institutional debt.
Right.
If we're going to go buy a company and exchange stock, you need to have a level of financial rigor that is likely not in place today because you probably don't need it, right? So why would you have a lot of rigor in place that you don't need? And that is frustrating and annoying to people who aren't ready for it, right? And I think that's the number one thing that, we as an industry could do better of, because there's a lot of frustration, oh, here come the private equity guys, like it's like you're descending into their company and you're helping build out some of that financial rigor. And sometimes it is over the top. Sometimes we don't get the things right and it's a little overbearing, but I think that's the push-pull friction point that people need to be ready for, and just say, if you're going public or if you're going in a direction of, I want every tool available to me, that's just the rite of passage every company goes through. And it's, it can be a little annoying if you're not excited about it. Yeah.
Well, what I've heard from each of you in some form or fashion is, what tends to be the best fit is someone who has a very specific reason to sell. Like they know why they're doing this. They've tried all what they can do without help or strategic or financial partner. And they also, have a shared vision. It's not like somebody's telling them what to do against their will. They have a very specific pre-existing desire to go realize the company's full potential. And so, obviously that doesn't translate if you don't have a vision and you're good with, staying flat and you just want to get away from it and take your chips off the table. Obviously then that's never going to work. So, no, I just think that's a great point of clarity for a lot of folks, just to kind of understand their own strategic options as they think about, what they might do in the next 1 to 3 years. Hey guys, I don't know about you. I've enjoyed this so far. A couple more questions. I kind of let's talk about the future, the back half 26 and maybe even get to 2027. What should we expect? We'll start with you, Tom.
Well, I think hopefully, we saw today in oil prices and we have a MOU to end the war.
We got 2 weeks to screw that up, Tom, before this airs. So we'll say
my air quotes. I mean, but assuming, things tamp down, oil prices start to recede, not all the way, down as low as maybe, the president's saying, but just take that pressure off, which has been driving inflation a lot, which, I think we all saw that, my biggest concern in the second half was, even a few weeks ago, that, we keep driving inflation and driving the consumers, there's going to be, there could have been a break point at some point here. And that would have, made things, started to destroy demand on the consumer side, which they've sustained really well so far. I just saw, B of A just did their, monthly report, and there was, consumers are hanging in there. But there's a point, if this keeps going, or, especially the lower end consumer, could begin to fall out, which could, start to cascade through the economy more than we would like. I'm feeling like maybe hopefully that we've tipped the scale and we're moving backwards, which inflation will begin to subside. Hopefully eventually means interest rates will begin to subside. So, the capital needed to do acquisitions, will people can see visibility into rates lower in the next 12 to 24 months in their investment period on new deals. I think it will get people to be more aggressive and more active in doing deals if they feel like it's okay. It's a floating rate deal, so it's going to be better. And I might have to have a few months or half a year from really high rates, but maybe in the next 24 months it comes down, and then I'll be able to refinance again and maybe do a better debt structure as the company's scaled and grown. And I think if people start to feel confidence that the inflation will subside, the geopolitical risk will begin to subside, therefore rates will begin to hopefully subside. I think you're going to see there's a lot of JJ said earlier, there's a lot of pent up capital out there. I mean, it's been a quiet 3 years relatively, and I think when people see multiple green lights hitting, it's going to get very busy. I mean, which is the periods you also got to be careful, because then things will get, people get really aggressive because there's going to be people in funds that have to get money out the door to go out and raise the next fund, and that's could drive some people, sellers will win by that because people will come in aggressive just to get capital out the door when they feel like the things have aligned. But I think the general theme is it's going to be busier the next 12 to 24 months than I think it's been in a while.
What's in your crystal ball, JJ?
Well, I agree with everything that Tom said. I think like the wild thing is just the magnitude of the news events and how quickly people shake them off right now. I mean, like it's head spinning for sure. With that said, this has been the busiest year for us ever at Eve. I think we feel very strongly about the macros. Like I said, the supply side is changing dramatically and creating a really good backdrop. That's bringing more people who, if you kind of wanted to sell 4 years ago and you missed it, you've now sat for 3 years waiting for the market to get better, and all of a sudden that kind of builds, and there's just a lot of activity. There's a lot of inbound calls, a lot of things going on, and I think we're seeing the kind of top end of the funnel just get wider and wider and wider right now. So to Tom's point, it can be a bit frothy and create things where you have to push through and find the quality for sure. But I think next 6 months, next year, next 2 years, if you see the demand side kick up as well in support of the supply side dynamics going on right now, you're already seeing truckload prices nearly equivalent of where they were in COVID. So it's obviously set up to be a really good 2 to 3 years for sure.
I like that. Let me wrap with a little bit of a personal question, if you guys don't mind. Each of you have had 20 years of success, and I'm just interested. Why do you continue to do what you do? What gives you satisfaction, or the most satisfaction, from being an investor, specifically in transportation logistics? I'll start with you, JJ.
All right.
Well, I mean, for me, this one's easy. I've been in this industry now for 20 years. Tom's, one of my very, very good friends. I see him at all the industry events. I live 2 miles down the road from him. I never see him. I mean, like, I go to the events and go to people around the industry, and it's all, it's all my best, for me, it's all my best friends. I love the people in the industry. It's a world-class group of people, and every time you meet a new company, and I mean, it's just a great industry with great people.
Yeah, it's like I said, JJ's fault. I ended up in this sector in 2003, and we were coming out of the .com boom and bust, and we said, he goes, Connolly, there's real companies that do move things and make real profits. It's trucking and warehousing companies. And I was like, man, that sounds really interesting. And then we kind of went on the journey, and, even in the early days, when we were just getting started, and we would show up at industry conferences and just got to know a lot of the competing investment bankers and CEOs and owners. And, some of them were small businesses. And now some of them are the prolific CEOs of the industry, and getting to watch this sector evolve, and then being able to be part of one of the biggest stories ever in the industry with Brad, and learning from him as well. And I simply say, I really love it. I enjoy it. It's JJ said, we go to the events, all of our friends now are, doing very exciting things in the industry. But I love it because it's the most fun part about it is getting involved with companies and helping build and helping people achieve success and grow businesses, and being part of that. And doing what you say you're going to do. And, I've always held myself accountable to that. And, I think JJ and I both can collectively say, out of the 100+ deals that he's been involved with the industry, everyone's still referenceable, still a friend. And we've done deals the right way for a long time, and people want to continue to deal with us. And when our situations come about, we've done it the right way for a long time. And that's why it's a lot of fun. I mean, it's, the fact that we're getting to be the statesman of the industry at our, getting older, it's see these young 20-something year younger kids come up and watch them is exciting. And but where the industry has such a huge impact on the economy, and I think JJ said it still has a huge opportunity left because there's still a lot more institutional capital that can come into the sector. And I think the next 10 years is going to be really exciting with AI, robotics. I mean, there's just so much change going to happen. And that's, very exciting to see what's going to happen next and be part of hopefully another story or two.
It's funny. A lot of the folks that we talk to, that's exactly what they say. I've worked so hard to kind of get to this point. And yes, I'm tired and I'm out of capital, but I don't want to miss what's next. Like the next 10 years is going to be the Super Bowl of logistics. It's going to be the most exciting period ever. And so anyways, guys, I really appreciate you sharing your insights here with us today. Should any of our audience want to contact one of you statesmen, as you described it, Tom, so JJ, how can they get a hold of you? How can they tune into your education that you put out in the market?
I've got a LinkedIn. I think that's the best way. Also email jj@evepartners.com, but LinkedIn, we'll connect. And then I've got a sign in for the newsletter there.
Perfect. Tom?
Yeah. Obviously LinkedIn's always very easy as well. And then, emails tom@reddogequity.com.
All right, guys. Hey, stay sharp out there. It's going to be fun. And the rest of 2026, that's going to do it for us, guys. We'll see you soon.
Super Bowl. Let's go.